Welcome to this explainer. I am absolutely thrilled to be diving into this material with you today. If you've ever looked at the financial markets and just felt totally overwhelmed by the endless charts, the complex jargon, or the sheer dizzying speed of it all, you are in the exact right place. Today, we're going on a journey to demystify the markets and, more importantly, discover your personal financial market identity. Because, let's be real, before you put a single dollar on the line, you absolutely need to know who you are as a market participant. Okay, let's dive right into our roadmap for today. We're breaking this down into 5 clear buckets: entering the market, day versus swing trading, fundamental analysis, the EIC framework, and finally, technical analysis demystified.
All right, part 1, entering the market and setting your goals.
Before we even think about looking at a chart or a balance sheet, we have to ask a pretty foundational question. What is your actual goal when you put your hard-earned money into the market? True investing is spending money today to grow your wealth in the future by buying high-quality assets. It's taking a long-term view. I want to highlight a really sharp contrast here. True investing means aiming to own a fantastic business for the long haul. It is completely separated from pure speculation, taking huge risks on hype, and it is definitely not gambling, where you're relying entirely on luck with an all-or-nothing risk.
What's really fascinating here is how your chosen time frame completely dictates your risk level and the specific tools you're going to need to use. Notice how investing happens over years or even decades with a moderate risk level, and it relies heavily on fundamental analysis. But if you shrink that time frame down to minutes or weeks, you're trading. That drastically raises the risk level and requires technical analysis. And if your time frame is instant and based purely on emotion, well, you're just gambling at that point. Your time frame literally becomes your identity.
Moving right along to Section 2, day versus swing trading, choosing your pace.
So if you've decided that active trading is your path, you now have to take a hard look at your daily lifestyle and your personal risk tolerance. We essentially have 2 primary styles here. On one side, day trading. This is an adrenaline-driven, glued-to-the-screen world where trades last minutes or hours and the stress is undeniably high. On the completely opposite side is swing trading, a much slower, far more methodical approach that takes place over days or weeks, requiring significantly less daily screen time.
Let's break down the day trading profile. In this world, you must be fast. Your opening and closing positions all within a single trading day. The massive benefit here? Zero overnight risk. You sleep soundly knowing your capital is flat and safe. But the cost is your full-time attention. You literally have to react in a matter of seconds. You are heavily reliant on incredibly powerful computers, expensive charting software, and lightning-fast trading platforms. Because you're looking to scrape profits from tiny, high-frequency price movements. It is a high-speed, high-stress reality for sure.
Now let's slow the pacing down a bit and look at the swing trading profile. Here, you are holding positions overnight, sometimes for days or even weeks at a time. Because of this longer time frame, it's actually pretty part-time friendly. You don't need to stare at the screen all day long. You're looking to capture much larger price movements per trade. However, you are exposed to overnight and weekend market risks. If terrible news breaks on a Sunday, your stock might plummet before you can even pour your Monday morning coffee. To combat this, swing traders rely heavily on tools like stop-loss orders to automatically protect their capital while they sleep.
Section 3, fundamental analysis, finding true worth.
We are totally shifting our focus right now. Moving away from the how of trading, let's look at the what. Specifically, how do we actually know what to buy? When there are thousands and thousands of companies out there, how do we separate the massive winners from the losers without just blindly guessing?
The answer to that is fundamental analysis. This is a method used to calculate a security's intrinsic value. Think of intrinsic value as the absolute true worth of a company based on its real earning potential. So the crucial point is this. Once you calculate this intrinsic value, you compare it to the current market price. If the actual market price is sitting below your calculated intrinsic value, boom, the stock is undervalued. That is your clear signal to buy, because fundamentalists believe that eventually the market price will wake up, correct itself, and rise to meet its true intrinsic value.
Section 4, the EIC framework, a 3-step process.
If fundamental analysis is the broad theory, the EIC framework is your ultimate practical tool. I want you to imagine holding a giant magnifying glass. The EIC framework forces you to use it in 3 distinct steps. Step 1, you start with a satellite view of the entire economy. You're looking at GDP, inflation, monetary policy. Is the whole country financially healthy? Step 2, you zoom in one level to the industry. What stage of the life cycle is this industry in?
Are there massive technological changes happening or really stiff competition? Step 3, finally, you zoom all the way down to the specific company. You dive into their financial ratios, sure, but you also look at who is actually running the place.
Let's look a little closer at that first step, the economy. The economic cycle naturally moves in a continuous wave, from an expansion up to a peak, down into a contraction, hitting a trough, and then repeating all over again. Finding exactly where the broader economy sits on this cycle is absolutely critical for timing your long-term investments. From an investor's perspective, that upward slope, the expansion stage, characterized by rising production and strong consumer spending, is the ideal time to invest so you can grow your wealth alongside the overall economy.
And skipping right down to the final step of EIC, we have company analysis. Look at the balance required here. You have to assess the hard math, financial ratios like earnings per share, which is simply how much profit each individual share generates, and return on investment, which tells you what you actually get back for what you put in. But you also have to weigh qualitative factors. Honestly, this brilliantly illustrates how fundamental analysis isn't just crunching boring numbers on a spreadsheet. It's about understanding the people, the management's vision, and the actual corporate culture running the business.
Which brings us to Section 5, Technical Analysis Demystified.
All right, we are officially leaving the world of fundamental balance sheets behind and stepping straight into the fast-paced, pattern-driven world of the active trader. Technical analysis rests on one massive foundational principle: the market discounts everything. Technical analysts firmly believe that absolutely all known information, every economic report, every fundamental ratio, every piece of news, and even human psychology is already baked into a stock's current price. Therefore, studying the fundamentals is totally unnecessary. All you need to study is the price itself.
Building on that, we have the core assumptions of the technical approach. First, prices move in distinct trends. They go up, down, or just stay flat. Second, history always repeats itself. Why? Because of the third point, human psychology. Fear and greed? They literally never change. And this market sentiment creates visual, highly predictable patterns on a chart. Finally, volume. The sheer number of shares being traded must confirm the price trend to prove it's actually real. If you can spot these repetitive psychological patterns, you can absolutely exploit them for profit.
So, what does the actual technical toolkit look like? To track these trends, traders use specialized price charts, most commonly Japanese candlesticks, which show the open, close, high, and low of a time frame. Then they layer on mathematical indicators, like the RSI or MACD, which basically act as speedometers to gauge the market's momentum. And they map out psychological battlegrounds called support, a price floor where buyers eagerly step in, and resistance, a price ceiling where sellers take over. Together, all of this builds a complete visual language of the market, helping traders time their precise entries and exits.
Well, we have covered a tremendous amount of ground in this explainer today. We've looked at the long-term, economy-scanning world of the fundamental investor, the lightning-fast reflexes of the day trader, and the methodical, chart-driven tactics of the swing trader. So, I want to leave you with this provocative thought. Take a hard look at your own goals, look at your lifestyle, and ask yourself honestly, investor, day trader, or swing trader, which one are you? Pick your path, dive into the analysis, and I'll see you in the markets.